I hope everybody's having a nice weekend after what was an incredibly volatile week. And I just wanted to go over this evening some things with you to review what our strategy is going forward. Something I always use is scenario analysis, in which when I send out the quarterly newsletters and client commentaries, I talk about the best case scenario, the worst case scenario, and our baseline middle case scenario. And in this case, with what's going on in the economy right now, we have a very wide margin for the best and worst case scenarios. And this is specifically true after the 1-2 punch that we were delivered over this weekend. The first thing that happened was a 30% decline in oil. And that effectively changed the world from an energy standpoint. Now, earlier this year, I had sold our energy positions because I felt that from a long-term perspective, I didn't want to own and be an equity owner in energy companies because energy would be between $50 and $60 a barrel. And that was a prudent decision for what's occurred this year. However, I didn't mind owning the debt of our energy companies because I didn't feel we were going to have bankruptcies for the energy companies over the next 1 or 2 years if oil price stayed within that range. After a 30% decline in oil over the weekend, when we have effectively Russia and Putin fighting with the Saudi prince over the price of oil, that changed the world when oil price is now at 30 and possibly lower, where I don't believe a lot of these companies can remain solvent for too long. So we've effectively sold off a great deal of our energy positions on the debt side also within this week after the massive sell-off, because I don't see a recovery there. So when I see things happening from a change the world type perspective, I feel it's an issue where we don't want to be lending money to those companies or long-term owners. Then we'll get out of that sector. And that's what we did this week in the energy side. The second component and part of this 1-2 punch that we've experienced this week is, of course, what's going on with the coronavirus. This one's a little bit more difficult, again, to establish. Again, 2 scenarios can happen with the coronavirus. It could be that it's temporary, it's not that big of an issue, and we go into a slight recession or a dampening of GDP and spending and earnings is impacted, especially in the hardest hit sectors of hospitality and airlines, and it gets into small business, and that we have a quick ramp up of spending, that's pent up spending that occurs in the subsequent months, and we have this V-shaped type of recovery. And we've seen that a lot in the last decade, where the market gets scared, we have a 10% or a 15% or 20% sell-off, and then we have a quick recovery. That's one scenario. The second scenario is that this has an Italian type of situation where the coronavirus is much more widespread, we're unable to contain it, and it has much more damaging impact not only on our health and our lives, but has also a longer lasting impact on the economy and through the remainder of this year. And then you throw in political instability too in that scenario, and then we're in for a little bit deeper recession. For that reason, I think the second scenario is the more likely one, and regardless, I want to plan more for that second scenario to protect our positions better. So we were at 50% stocks, 52% before this for most of our clients' balanced portfolios, and just like I own the same stocks and bonds as you do in your portfolio, and we were at 52% equities for our 401k at Altrius for all of our associates also. And what I wanted to do though is get us down to 40%. And I say that getting us down to 40% is more important right now, and holding a bit more cash. Because if we're in for this longer scenario, that's going to give us some opportunities if we go from the 20-25% correction that we saw and we have another 20% downturn, then that would be very damaging to stocks, and we'd rather be underweight and safe than sorry. We could have a day like yesterday where the stock market rallied tremendously, we made 8-9%, and our balanced portfolios made about 4-4.5%, and we'll get some of that recovery on the upside. I just want to protect us some more, however, on the downside. And be a little bit more prudent. And the reason that is because if you look at past recessions, whether it's the dot-com bubble of 2000, or if you look at the financial crisis, or you go back to 1973-74 or the 87 bubble, or most recessions in history, you kind of get these fake-out recoveries where a lot of the people who need liquidity, a lot of the larger banks, hedge funds, who are caught flat-footed and have a lot of leverage, in their portfolios, which we of course never use. What they need to do is cover their positions. That's why you see things even that are safe havens like gold or safer bonds rallying. So under that scenario, I don't really want us to be as unprotected in a further and deeper type of recession scenario. Now, the income of our portfolio is still at about 5%, even though we're sitting on a little bit more than 10% to 12% in cash. The absolute income is still down a little bit, but I believe we'll be able to get that up by finding value in the bond market for companies that I don't believe will go bankrupt. And we'll be a little bit safer and where we can get those 6 or 7% yields and find some selectivity, because now there's a lot of opportunity in the high yield bond market where there's fear, and in companies that I don't think are going to go bankrupt, and that we'll want to buy into. And of course, as always, we don't want more than 1% in any position that we own, because we know we're going to have some bankruptcies across the board in certain sectors and in certain companies. Mathematically, over longer periods of time, you're usually getting between 3 to 5% in past recessions in the high yield bond market. So that's my thinking for our overall strategy going forward. I'd rather be safe than sorry when going through recessions than attempt to be a hero and try to get us better returns by getting in again too quickly and all in. Of course, we're still long-term investors from the standpoint of owning Pepsi and Procter & Gamble and Kimberly-Clark and the types of companies that we own domestically, and then international companies like Nestle and Unilever and Diageo. And these are names I think that we can hold and that will hold up better. They're certainly going to go down in the short term if we have and experience more volatility. However, they should likely be able to continue to pay their dividend just as they have for us in past recessions. So it's just, I think, a more prudent way for us to look at things. Again, we've always been a top-down firm first. I try to look at the global impact of what's going on and where are the opportunities, where are the risks, and how to best weigh those two things, because there's never a green light in investing that says go ahead and invest, and a red light that says absolutely not. There's always a lot of uncertainty. In the Marine Corps, we called it the fog of war. You just don't know which is the best action to take, and you have to press on with a prudent plan and the best case plan to get you to where you're trying to go. So that's the thinking that we have in the portfolios right now. We certainly are going to experience more volatility. I don't think we're out of the woods just yet, even though we had a nice rally yesterday. I think there's certainly a lot more volatility to come, especially when we do more testing on the coronavirus and more of us have it that we don't even know that we had it, and we're out there spreading it. And there's going to be a human toll, and that could weigh on the psyche further. So again, these two scenarios, I'd rather prepare for the second one and be pleasantly surprised. And that's my thinking. If you have any questions about your specifics, these are times that can be troubling. A lot of us have been through this before over the last 23 years that we've been in business. We've been through two of these significant recessions, many more through my lifetime. And then as an economic historian, I like to look back at even other ones that have been through to see how, and history never repeats itself, but it often rhymes. You can find some similarities. I've been saying on Fox News a lot lately that the overvaluation of a lot of the big cap growth stocks, the MAGA stocks, Microsoft, Amazon, Google, and Apple, and of course Facebook, those stocks, a lot of them just got so significantly overvalued. They're still overvalued. And the similarity to me was the Nifty 50 in the late 60s, which didn't collapse until the 1973-74 correction. And during that correction, all those stocks, Polaroid was one of them, which was selling at 90 times earnings, and the Nifty 50 were selling about 50 times earnings. They all came back down, and it took that correction to get things reasonably priced. Our stocks going into this were at 13 to 14 times earnings, and were very cheap. They get cheaper because the baby gets thrown out with the bathwater. But I think that we're starting to see that our stocks likely won't go down as much, and that when people start to get serious again about picking, and they're just not running after momentum, that they're looking for opportunities of quality companies with quality earnings that pay dividends, as people look again, they're going to come back to the stocks that we own, and active management is going to matter again. And I think that's where we can add a lot of value. And again, if your personal circumstances have changed, or you're concerned, please don't hesitate to call us. I mean, it's 10:30 here. Oh, it's almost 11 o'clock on a Saturday night, and I'm working. So if you email me, you're going to get an email back. I know this is extremely tiring on a lot of people's psyche, and especially since we're indoors right now. But don't hesitate to call and or email me if you have any questions about your specific portfolio or circumstances or any of your financial planning matters. Continue to appreciate your trust. We've been through this before. We'll get through it again. I know, unlike 9/11 or other things we've been through, this one's a little harder in that we can't hug each other. We're supposed to be distancing ourselves, and that makes it a little bit more difficult under this scenario. And part of the kindness that we have to have for one another is, I was talking to a client earlier, it was his birthday, and it's, you just can't celebrate the same way we normally do, but we'll find different ways to do it. And I just wanted to let you know, that what I was thinking, get this out to you as a brief, because I'm very thankful also that we just haven't received many calls. Most of the calls we've received have been from clients saying, hey, do you think it's time to get back in? Or I've got $100,000 sitting on the sidelines. Do I want to, put it in now? And my answer is, I'm not sure. We probably want to start, nibbling and getting some opportunities. And it's maybe because of our strategy that clients have been through this, that we're not getting calls, or maybe just because you know that we're busy and spending more time thinking about these things. So, but don't hesitate to call or email if you have any questions. I deeply appreciate your trust. And we will get through this again. But I just wanted to get you my thoughts out tonight. All right, take care and take care of yourselves. And we'll talk to you again soon. All right, bye-bye.